Okay, good morning everyone. Welcome back to the channel. We are finally doing it. We are doing part 2 of Coursera. I know it's been a while. My last video that I posted, I know there's been a couple people asking for part 2. Delayed it for the longest time. That was my bad, but we'll go ahead and start that today. So again, this is my last video that I had for Coursera. This was published around June 5th of 2025. This is the first video you're watching. Definitely watch this one first. But anyways, so June 5th, 2024, current market cap for Coursera at the time was $1.13 billion, going for $7.24 a share. So 7 months later, we are finally seeing a little bit of movement, nothing crazy. So 6 months ago, around $7.24. Pretty much we're seeing about an 18-19% gain in the past 7 months. So we're starting to finally see some movement in this stock. So as of today, this is going to be January 6th, 2025. Happy New Year's, everyone. Coursera is going for $8.71 at a $1.38 billion valuation. I'm just going to go ahead and do a run through of all the financial data. Pretty much I'm going to do a quick highlight of everything going on, especially because I've seen some major improvements in the past 7 months for this company. So we're going to do some quantitative stuff just to give a quick update on what's happening with the company. And so people who haven't seen part 1, pretty much just watch this video and catch up. Okay, let's go ahead and start with the Excel spreadsheet. Again, one of the first things I always do when researching a company, go through their financials, income statements, their balance sheets, and their cash flows. So I'm just going to go ahead and export this data. All right, so let's go ahead and get started. So if you're looking at this sheet right now, just know that my right side right here, the M column, this is going to be the latest data. Let's start with the top line, total revenue. We are currently showing 8 consecutive quarters of year-over-year total revenue growth. Although it hasn't been growing as fast as it was back in 2023, it posted 165 in September of 2023 versus 176 in September of 2024. That is only a 6% year-over-year gain. But if we move on to earnings per share, we have 7 consecutive quarters of earnings per share growth. Huge improvement in their earnings per share in the latest quarter. Back in September of 23, they posted negative 0.21, and now they posted negative 0.09. That is a 57% year-over-year gain. And if you take a look at the trend of earnings per share from 2022 all the way to 2024, you could see that the trend is trending towards positive earnings per share, so that is a good sign. And they are improving it year over year. Next up, profit margins. There has been an improvement from their profit margins back in 2023 till today, currently making 54.6% in their profit margins compared to 50% on the latest cash flow from their most recent quarter, posting 11 cents compared to 9 cents back in 2023. That is only up 22% year over year. And their cash flow from operations are only up 40% year over year. So 2024 overall is probably going to be one of the best years for Coursera for improvements in their cash flow. Lastly, down to net income, they posted negative 13 million versus negative 32 million back in 2023. That is a 57% gain year over year. We like seeing green in this spreadsheet because it does show that the company is improving. So as you could see from, I guess you could say from around 2021 of this company, done nothing but go down. But if you take a look at their financials and you compare it to the stock price, it's been nothing but improving. Because if a company keeps improving their fundamentals, there's no way they could keep going down forever. And also, if you take a look at their balance sheets, so a company with 700 million plus in cash, no long-term debt, going for a $1.3 billion valuation seems a little undervalued to me. Company with a lot of cash and no debt cannot go bankrupt. So don't let the fluctuations of the stock price scare you out. So on this part of the video, I'm going to go through the steps line by line because it might get a little confusing, but we're pretty much going to talk about how operating expenses affect the bottom line. And more specifically, we are going to focus on research and development expenses, and also under total operating expenses, they are also going to have sales and marketing. They don't have it listed here in Seeking Alpha. I'm going to go ahead and pull up their 10K form, and we'll go through each section individually. So software drives today's economy. We all agree on that. And because software requires fewer assets to generate larger income streams, physical assets have become largely irrelevant. Everything's code. They don't have any big factories. They don't have these huge machines that they could depreciate. So most tech companies are deploying billions into sales and marketing and also research and development to grow their future earnings. This spending is anchored in sound business logic, but it has an effect in depressing their current earnings reports. So in the digital age, it's increasingly obvious that tech companies' current income statements are an unreliable measure of its long-term ability to generate cash flow. What happens is GAAP accounting requires nearly 100% of research development and sales and marketing to be immediately expensed in that year. And so when you're comparing that to a company that does have a lot of hard assets, property, plant, and equipment, they're allowed to depreciate over many years. So let me say that again. So you have two different companies. One company is going to have a lot of hard assets, property, plant, equipment, and they're allowed to depreciate all those assets over many years. And that's because of GAAP accounting rules. Now you go to the other side of things and you have a tech company. Tech companies don't really have to spend too much money on property, plant, and equipment, but they do have to spend money on research and development and in sales and marketing. But under GAAP accounting, they do require 100% of that to be immediately expensed in that same year. We'll go through all this step by step, but basically I'm just gonna create a hypothetical scenario. This is just a way to sort of think of the total operating expenses of a company differently. The first thing I did was pretty much take operating expenses, and we're looking at yearly data right now. And I'm just going to take the total operating expenses, which is this line right here. Now what I'm going to do is split sales and marketing and also research and development expenses out of the total operating expenses. Research and development 2021, they have 135 million, 165 and 160 2023 respectively. Then I have also put in the sales and marketing already. Sales and marketing 179, 227 million and 222 respectively. Next line that I have is going to be earnings per share. This is going to say not amortized. I basically have earnings per share up here on the spreadsheet, and I'm just adding the R&D and sales and marketing to that earnings per share, which is going to give me 1.9 earnings per share without the marketing expenses. So how would our earnings per share look like without spending on marketing? So say Coursera, I'm going to hypothetically amortize the sales and marketing and research and development. So just the same way a company with hard assets, what I did was I added the sales and marketing and research and development. We're just going to create this fake scenario where we amortize the sales and marketing of Coursera and also the research and development over 5 years instead of just having to spend that expense in 1 year. SLN is a straight line depreciation formula, which is going to evenly spread the cost of an asset over its useful life. And this formula will calculate the amount of depreciation expense allocated for each period. And my period that I'm going to put is just going to be 5 years. There's nothing specific with 5 years. We're just going to choose 5 years. So what we're doing is pretty much taking sales and marketing and R&D, and we're turning it into a hard asset, and we're going to try and put a straight line depreciation method and then apply it to Coursera and see how it affects their bottom line. All right, so this right here, these three numbers are going to give me our marketing expenses and research development that we use the straight line depreciation method. We're just going to add in that number into the earnings per share, view how their earnings per share would be if we were able to amortize their expenses. In this hypothetical scenario, earnings per share that would have been posted is going to be 0.02 compared to what they are posting of negative 0.50. So basically what I'm trying to say is, so if tech companies are allowed to amortize their sales and marketing and research and development, their numbers on the bottom line, earnings per share and net income, would automatically look better. So yeah, that was a lot, but that was pretty much it. Did that make any sense at all? I guess let's just do a little takeaway from everything. Pretty much to sum up the whole video, if you could spend marketing dollars today to add profitable customers for years later on, then it doesn't really matter if those marketing dollars and research and development dollars are depressing your current earnings. I think some of our accounting standards are just old and haven't been updated, but if you're on to some tech companies, I think you need to rethink the way you think of sales and marketing and research and development. So think of it as an investment and not as a cost. Of course, on the bottom line, it's still gonna probably show negative. That's just because of our old accounting standards. And yeah, I think that's it. Let me know what you guys think in the comments. I know part 2 took a little bit of time to release. Yeah, I just want to say thanks for watching, guys. Thanks for keeping up. Don't forget to like and subscribe. I'll definitely be pushing more videos out this year and try to be a little bit more consistent. But anyways, thanks for watching. Happy New Year's. Happy 2025, everyone. And we'll see you on the next one. Peace.